Hello, this video would help you understand Chapter 6 of Accounting Management. It's about relevant information for decision making with a focus on operational decisions. I'd like to help you quickly go over a previously learned concept of opportunity cost. It's a value associated with the next best alternative that is given up. Simply, it is foregone profit. Here I have an example to quickly help you understand how to calculate opportunity cost. We have a juice company called Nantucket Nectars. They have the alternatives to either produce peach juice or papaya juice or mango juice for a different level of profit. For example, if the company decided to produce mango juice to get a expected profit of $80,000, the opportunity cost associated with this decision is $7,000. That is a higher one in the other two choices. If the company decided to produce peach juice for a profit of $50,000, the opportunity cost would be $80,000. Again, that is a higher profit that is given up. So opportunity cost is foregone profits. Outlay costs refers to any concrete business expenses, including material or labor cost, but it does not include foregone profit. The material or labor cost of producing mango juice are $40,000. This is a very typical outlay cost. So I want you to differentiate outlay cost and opportunity cost. Outlay cost are concrete business expenses. Net financial benefit. The juice company has a machine for which it paid $50,000 and is now sitting idle. So you roughly know that the company has paid $50,000 and it has the choice of either produce mango juice or papaya juice or peach juice. If it go with peach juice, the expected revenue would be $50,000. For papaya juice, the revenue would be $60,000 and mango juice would be $80,000. The outlay cost for the three products are the same. It's $10,000. So what is the net financial benefit from producing mango juice? So if the company decided to go mango, the revenue would be $80,000. And the outlay cost, which the company has paid and stays the same across alternatives, is $10,000. So the financial benefit before opportunity cost is $70,000. So I want you to look at here is financial benefit before opportunity cost, which is $70,000. The opportunity cost the company paid off is $50,000. That is how much the company has paid on the machine. In this case, is $50,000. So after we take off the opportunity cost from the financial benefit, we got the net financial benefit of $20,000. So that company would gain $20,000 net financial benefit using the machine to produce mango juice. Then it would use it for the other choices. Make or buy decision. Financial managers are often need to decide whether to produce a product or outsourcing it, of buying it from an outside supplier. So in this make or buy decisions, the juice company that we have mentioned before, they would either pay a specific amount to make these 12-ounce bottles of 1 million bottles, or they can outsource it. Okay, let's look at how much they pay if they make the bottle. They would pay $60,000 direct material, $20,000 direct labor, and $40,000 on variable factory overhead. And the fixed factory overhead is $80,000 for a total of $200,000 of making this 1 million bottle. So on the right hand side, I have a column for you that is per bottle cost. So on each bottle, the company would pay 6 cents on direct material, 2 cents on direct labor, 4 cents on variable factory overhead, and 8 cents on fixed factory overhead for a total of 20 cents. The company has an outside supplier who offered 18 cents per bottle. Should the company make or buy the bottles from the supplier? The decision would be based on if the fixed overhead is avoidable or not. If the company will continue paying the $80,000 of fixed overhead, which is unavoidable. Let's go back to the table. This is $80,000 fixed. If this fixed cost is not avoidable, that means the fixed cost would become irrelevant. In this case, if the company make the product, they would pay this $80,000. If it buy from outside supplier, it will still pay this $80,000. In this case, the company should make the bottle by themselves. Okay, so look at this table. This table listed all the cost, including the irrelevant cost. So let's look at the make alternative. So if the company make, they would pay a total of $200,000 or 20 cents per each. If the company buy, it will pay to an outside supplier of $180,000 or 18 cents per each, plus the unavoidable fixed overhead of $80,000. So the company would have to pay $260,000, which is $60,000 more if they make. If we look at the per unit cost, they would pay 6 cents more to buy than if they make the bottles. In this next slide, it only lists all the relevant costs. It did not include the irrelevant cost of $80,000, which is the fixed overhead. That is the unavoidable cost. So if we take this line off, that will be this relevant cost comparison. So we can compare how much the company would pay if they make the product and they pay if they buy the product. So in this case, if the company make the product, they would pay $120,000 as relevant cost and $180,000 as relevant cost if they buy. So again, the company would save $60,000 if they make, which is the same as the irrelevant cost comparison. So the company would save $60,000 if they make. Okay. Note that unavoidable fixed costs of $80,000 are irrelevant because it does not matter if the company make or buy, the company has to pay this $80,000, and this $80,000 would need to be added to whatever they paid to the supplier. That will make the cost much higher. So the better decision for the company is to make. In the case if the company can avoid $50,000 of fixed overhead, for example, the company is able to not hire a manager, that will save them $50,000 as manager's salary if the company buys the bottle from a supplier. So in this case, within that $80,000, $50,000 would be avoidable and $30,000 would be unavoidable. So should the company buy or make the bottle? In this case, the company still should make the bottle. Let's look at why. Here, this is the table that include relevant cost and irrelevant cost. So let's look at the unavoidable fixed overhead. There is a $30,000 irrelevant unavoidable fixed cost. So this $30,000 would stay. Doesn't matter if the company make or buy. But the company is able to get rid of that $50,000 by not hiring the manager. So in this case, this $50,000 would become avoidable fixed cost. So if it buy from outside supplier, this item would be zero. However, this unavoidable fixed cost of $30,000 would stay. So in this case, if the company make, it will pay a total cost of $200,000. Oh, it will pay 20 cents per each. But if it buy, it will have to pay $210,000 if it buy from other supplier or 20 cents per each. In this case, the company would save $10,000 in total or 1 cent per each. So a better decision would be to make. This table lists the comparison of all relevant cost. In this case, we took off the irrelevant cost of that $30,000. And here in the make choice, we only put in the avoidable fixed cost of $50,000. And this $50,000 would become zero if the company buy, because the company is able to get rid of the paying a salary for a manager. In this case, it will save $10,000 if it make, and 1 cent if they make. So the better decision for the company is to make. So I want you to remember, unavoidable cost, when it goes up, make becomes more preferable than buy. So that is when the unavoidable cost goes up. When avoidable cost goes up, buy becomes more preferable than make. So that's a good summary of the previous example. It will all depend on how much the company can avoid in terms of the cost. Okay, let's continue this example. If the company can avoid $50,000 of fixed overhead, that is the manager's salary, in the case if the company buy instead of making the bottles. Suppose the company can further use the released facility on other manufacturing activities to produce a contribution to profit of $50,000, or can rent them out for $25,000. What are the alternative choices? So in this case, the company would either make or they would buy and use the facility for other choices. In this case, the company can either make, they will pay. I have to stop in here. I am going to continue this lecture in my next video.